Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore. I am here with my two best pals, our hosts, the hosts of the show, the ones that bring the knowledge to the show. That's Jim Margraf and Josh LaTour. Jim and Josh, great to see you today. Thanks for having me on the show once again. And this week, you've got a good one, talking about some investment behaviors and how they might hurt your retirement and your savings and investments. But before we dig into that, how have you guys been? Jim, you just got back from a business/vacation trip, right?
Yes, I did. Yeah, I had a great time in Mayacoba, Mexico. I had a great time there in the Cancun area.
Yeah.
And it was a pretty cool property that was set in a mangrove swamp.
Wow.
So it was lots of wildlife, a lot of wildlife. Got to see everything from crocodiles to iguanas to raccoons and all kinds of creatures out there. So
yeah. Speaking of creatures, I noticed one just flopped out on the floor there behind you. We've got our mascot, Luna, today, right?
That's right.
Yes. Yeah, she joins us. She joins us a lot of times for the show.
I love right when you say I saw all kind of creatures. She walked into view behind you and just did just a flop. Like I'm just spent. Luna's had a rough day. She needs her rest.
Professional napper.
So that's for our viewers. You can watch this on YouTube. If you're just listening on the radio or on podcast, check it out on YouTube because you'll get to see Luna behind Jim there. At least a little part of her there laying on the floor. Well, hey, Josh, how have you been? What were you doing while he was down playing with the wildlife in Cancun?
Now that's a great question, Tony. Now somebody had to hold down the fort here. So that someone was me. And both not only was Jim on that trip, but so was Barb, one of our other advisors here in the office. And so I was
and your
the
dad
only
was
advisor,
out too,
and
right?
my dad was out. So I was the sole advisor left in the office. So.
Well, you've got those big, broad shoulders, buddy. I know you could carry it. You carried the weight fine, just fine.
Yeah,
I'm sure.
we got by for sure.
Yeah, that's good. But it's also good to have Jim back.
Oh yeah, it's good to have Barb back. Yeah,
went right on by me like that. Did you notice that, Tony?
I noticed this split-second pregnant pause, but it was also it's also great to have Jim back. Yeah. Oh yeah.
And Barb.
And Barb. Yeah. Boy, that pause there. You can read a lot into that, Josh. You got to watch that. No, you guys are fun. So you guys have been traveling. I've got nothing exciting to talk about. I spent Father's Day with my dad and family. I got to see them, gearing up for the summer concert series.
There
you go.
The summer concert series, because I'm going to a number of shows this summer. There's a lot of artists and bands. My wife and I are going to go to some concerts. We're going to go see there's a brand new amphitheater up here in Minnesota, a huge one. They've been building it for the last couple of years. It's a state-of-the-art concert facility just made for music. It's an outdoor amphitheater. And we're going to go see the lineup for the night we're going is Toto.
There you go.
The Romantics and Christopher Cross, the yacht rock guy who sang Sailing and Arthur's Theme.
Yeah.
Kind of a weird combo. We're going to see Toto. I love Toto. So
love Africa. That's it.
Yeah. Oh, you'd know more.
I probably would, but that's
Rosanna. Rosanna's another big hit. They had a few. Hold the Line. So yeah, they're earlier. You guys are too young, but they had most of their hits in the late 70s, early 80s. But Steve Lukather is considered one of the greatest guitar players of all time. I mean, he played on everybody's records from Steely Dan and Michael Jackson to if you hear a guitar solo on a record from the 80s, chances are it was Steve Lukather. So all those guys are session players. That's how they got together, and they're good musicians. It's fun to see them. Well, hey, let's dig into speaking of crazy behavior. Let's talk about behaviors that could hurt your retirement. Where do you guys want to start with this?
Well, Tony, the first one we want to look at is people that are really nervous about the market. They tend to hold too much cash. and they do it out of fear of losing too much, because they're worried that the market's going to take it from them. But there's the other side of things, is that if you leave it in cash, inflation is taking from you every single day.
Yes.
And so every now and then we sit down with someone that is very, very risk averse. They would prefer all their money was under the mattress. And the problem with that is inflation is constantly marching. It's just nonstop. So if you have $100,000 in your savings account today, yeah, you'll have that plus maybe a little bit of interest depending on the bank that you have. But where is inflation taking you on the value of that? So what $100,000 buys today, you're going to need $103,000 to $104,000 a year from now to buy the exact same thing.
Right.
Yeah, and that adds up if you're leaving it in there for the next 10 years, 20 years.
Yes.
That adds up. You're losing a lot. I mean, prices have basically doubled on things in the last 25 years. I mean,
less than that even.
Yeah.
So it's, that's one of the things that the market really does for us, is it keeps us up with inflation. Now, depending on how much risk you're comfortable with, you may not want to have a huge portion of your funds in stock, but we need to do something more than just leave it in a savings account in the bank.
Yeah. And don't leave it under your mattress. Don't bury it in coffee cans in the backyard, and don't just leave it sit in your checking account or say even a savings account that pays a little. They're not going to pay enough to even keep up with inflation.
No, they're not.
And that's not to say that you shouldn't have cash.
Oh, you should have an emergency fund, right?
Oh, sure.
You should have an emergency fund. But one of the investment behaviors is people don't, the market's too risky, I'm going to keep it all in the bank. And that leads to problems too.
Yeah. So I tell people, I mean, you want to have about 6 to maybe 12 months worth of expenses.
Right.
I think that needs to be something that's readily available. You've got some safety from the FDIC insurance on it. And I think that's fine. But when you start really getting into those higher amounts, then you're hurting yourself more than helping yourself. And then not only that, but we talked about the savings accounts that are paying pretty much 0 point nothing. There are high yield savings accounts that exist.
Right.
So do some shopping.
Sure.
Don't just leave it in the 0 point nothing. I mean, I talk to people all the time. Got 150,000 sitting there doing nothing.
Yeah.
Like, well, you could be getting 3%. And you still have the FDIC insurance. So do some, take some time, do the work, shop around, see what banks are offering. What you're going to have to do some looking. And generally speaking, those high yield savings accounts, they're going to be offered by the online only banks. And so just do a little bit of research. A Google search takes you a long way.
Yeah, it does. Yeah. And when we're comparing, we're looking at what the market does over time, and this is a reason why leaving too much in the bank is as much of a risk as investing incorrectly, really. Because the market long-term average is around 8%, right? But inflation is somewhere, the long-term average is around 3%. So that gives us a little bit of help against future expenses. So if I've got time on my side for a group of, or a portion of my dollars that I know I'm not going to need this for the next 5 or 10 years, I can take a little more risk with this and give it some chance to grow over time. Because do we know what the market's going to do this year? No. Do I know what it's going to do next year? No, we can't really answer that kind of a question, right? But when you start to look out and you get beyond 5 years and you're looking at 10 years and beyond, now the market averages really start to have an effect on our account, and it starts to really help us out. It's the time we spend, the time investing really does help out. The time spent in those positions really helps us.
Yeah, it's not timing the market, it's time in the market.
Correct.
As Warren Buffett always said, you're right. And that's exactly what you're talking about. Plus, you have 100 past years of market to look at. So the further out you go, the more you can be more confident about that growth and about the markets. What is it going to do tomorrow? What is it going to do next year? Maybe not so sure. Nobody has a crystal ball. But over the next 10 to 20 years, we have a little better of an idea because we can look at 100 years worth of data and see that over that time period, since the inception of the market, it has always gone up. Right. And there is an average you can look at. But everybody's situation and timeline is different. That's why you guys say, hey, call us. We're not giving specific individual advice. We're giving broad advice that and commenting why you need to work with a professional and have actively managed accounts. But I think your point there is you need growth, right?
Yes.
Yeah.
You need growth and you need balance.
Yeah, that's exactly what I was about to say. That striking the right balance of risk versus conservative investments, I think, is extremely important. And not only that, but over time, things are gonna shift. Your more aggressive things may grow more, and now you end up automatically having a bit too much in the more aggressive stuff.
That's
so
right.
Rebalancing is important. So failing to rebalance is one of those behaviors that can actually end up hurting your retirement. So making sure over time you're continually managing those funds, or you're working with a professional that can help manage those funds for you. And I think that's absolutely paramount.
I want to add on to what Josh just said there about the rebalancing, because that's something that individual investors don't do a lot of. And that's one of the big differences when you're working with a financial professional and professional money management is you're working with someone that's using a rules-based portfolio. And so that rebalancing is already going to be scheduled. We already know we're reviewing this at either the end of the month for this portfolio or the end of the quarter for this portfolio, and it's going to be rebalanced. If something has accelerated and grown an outsized amount, much more than the rest of the portfolio, we're going to bring that back into balance so we maintain the right risk profile. And it's important for individual investors to maintain your individual risk profile. So to what Josh just said, this is where the institutional and the financial advisors really come into play to help out and keep you at the right risk profile. Right. So when the market goes against you, it doesn't hurt too bad. But when the market's going positively, we don't lose out and miss it.
Plus, if they work with you, they have actively managed accounts. I was just talking to one of the senior portfolio managers yesterday, who I know deals with a lot of the clients' accounts, and they said they were able to silver took a big hit in the precious metals, and they had a certain percentage, not an overwhelming percentage, but they had some silver in their precious metals portfolio. And the day before it tanked, they got out of it. And somebody was asking, how in the world did you know? And they said, because every single day we have indicators and triggers. And we saw over the week leading up to it, we know to look for, we get a warning because we set, when this happens, let us know. When this happens, let us know. And when 3 or more of those things happen, we're out. And it did. And so, they're not going to get into the details of what their secret sauce is, how they did that. But a lot of it's actively managed on a daily basis. These people are looking at everything in all of these accounts. And you guys stay on top of it too, with keeping it balanced with your clients and looking at these for these indicators. Hey, we might want to rebalance now because you have a preponderance of this stock in your portfolio, and we feel it may have peaked and it's at record highs. So maybe that's too big of a percentage. You want to diversify a little bit, right?
Yep, absolutely right, Tony. Another thing that I think investors need to be wary of is just chasing yield or chasing high growth without understanding the underlying risk that's there. And I see it a lot. I mean, you get an initial public offering from SpaceX and the phones start ringing.
People go crazy. Like, I got to get in on this thing. This is going to be huge. They're going to they're bigger than Google and Apple put together. I got to have a piece of it, right?
Right.
And I can understand it. But at the same time, a lot of times these are very conservative investors, generally speaking, but they want to put a bunch of money into one stock.
Yeah, you might want to remind them of that the company hasn't made one dime in profit yet.
Right.
All they're doing at this point is spending money. Last quarter, I think it was I don't know the exact figure. I think it was around 4 billion in negative.
I didn't even realize that. So
yeah, no, I mean, but that's, Amazon operated for how many years in the negative until they broke through. But there's so much potential, but do you have the 20 or 30 years, that it's going to take for them to be that? They will become that company. I feel myself, that's my personal opinion. And most wisdom says, hey, they're going to get there someday. But we don't know about the technological changes that might happen once they start building those data centers in space. That could be huge, and they could make tons of profits from that. But to build one is going to take 10, 20 years. We don't know. It's going to take a long time, though, right? So
yeah. So what I'm saying is, whether it be SpaceX or whether it be, they want to go into Bitcoin or Ethereum, something like that, just because they've heard about the great growth that's there, and yet they consider themselves a conservative investor. So I think it's just important as an investor to evaluate, I can stomach this thing going up 50%. Can I stomach it going the same amount the other direction?
Yeah. Because once the employees at, say, a new IPO like that, SpaceX, the employees all have shares, and even the janitor or the maintenance crew there are going to be millionaires, but they're not allowed to sell any of their shares for a certain period of time. And when they are allowed to sell, I have a feeling the price that'll probably tank the price for a little while. So there's going to be some ups and downs, but we're not giving specific stock advice. We don't have a crystal ball. Each individual situation, some of our listeners it may be a good idea. Some of them, it's definitely not a good idea. So it depends on how much money you have, what you want to do with it, when you need it. There's so many factors, right?
There are, SpaceX is just an illustration of, the headline news articles getting everybody's attention everybody wanting to pile in. A little while ago, it was GameStop, and I had some people call me on that one, and they're like, I bought it via an ad I saw on TV, and I went, oh no. He's like, I need to sell now. I'm like, oh dear God, I don't even know how to help you at this point. Where are you even holding it? He bought it with a credit card online. I'm like, oh no. My word.
Don't ever do that.
And
oh my goodness,
I was just like, where do we go from here?
Yeah, and it's a tough one.
But the crazy thing was, like what Josh said, he was a very conservative investor for every other conversation we've ever had.
Yeah, it's amazing.
It blew my mind.
It's human behavior, right? You get excited. And who was it that told me? I'm trying to remember who it was, if it was Mike Binger or the president of Grady Investments. Someone told me, and this was just a couple of days ago, they said, I was in maybe it was Bill Altman. I can't remember, but they said they went into a McDonald's. And there were some couple of college age, like 4 college age guys sitting around a table having breakfast sandwiches and coffee. And they were talking about how they're getting into the SpaceX is it, and they all need to get into it. And he goes, when I start hearing people talk about it in a McDonald's, then I know it's too late. That's what he said.
It's exactly.
He said by the time it's spread that wide that just the average person is discussing the stock in a McDonald's, it's usually too late. I mean, he was kind of joking, but you have to be careful. Work with a financial professional and make sure it's actively managed and they know your whole picture. And because then people sell. They buy when they're excited and they sell. They might, if market declines, then they sell because they panic, right?
They do. I mean, SpaceX went up and then came right back down.
Yeah. And new IPOs often do that. And I'm not dissing SpaceX. I think they have potential to be the valuation. They are one of the largest companies in the world as far as the valuation is concerned. And that does make a difference. People say, well, I've heard they're worth trillions and their valuation has gone up. How can you say they lost money? Well, there's an actual profit and loss statement for the company. That's not what people are talking about.
No.
Yeah. And so in the long run, what their stock's going to be based on are earnings. And so, that's
exactly,
that's the thing.
Yep. That is it's a great point, and it's one that comes up every time that something like this happens.
Yeah, you guys probably get some calls, don't you?
Mm-hmm.
Always.
Oh yeah.
Hey, SpaceX, what can I do to get in there? Yeah, and can I put should I move everything?
Right.
Please don't do that.
So don't put all your eggs in one basket, no matter what the stock. Yeah. What's next? What other investment behavior do we need to watch out for? I mean, obviously there's fear and panic. We've talked about that. We've talked about going with the herd. We get excited because everybody's talking about something. What else is there?
I think the other bad habit would be neglecting paying attention to the taxation of the accounts that you have.
Ooh,
that's a good one.
That's a good one.
So, I mean, we have these traditional IRAs, 401ks that roll into the traditional IRAs. These are all pre-tax dollars. Right. And so if we just keep kicking that can down the road and fast forward, now we're into retirement, you reach those RMD years, age 73, and you have to start taking distributions.
Mm-hmm.
Well, if you have a lot of pre-tax dollars, those distributions could end up throwing you into the next tax bracket and really derailing your plans in retirement.
Right.
So at the very least, having the conversation about what do we need to do regarding the taxes on these dollars. It's not going to be the right thing for everybody to convert these funds to Roth, but for many people, it will be the right thing. And it definitely warrants a conversation with your advisor.
You know, Josh, we run, analysis for people on a Roth conversion. What would it look like if I leave those funds as an IRA versus what is it going to cost me in taxes if I do the Roth conversion? So we got to realize we're going to pay taxes either way. Mm-hmm. And so what's the cost in taxes if I leave it as an IRA? What's the cost in taxes if I convert to a Roth? I had somebody I did an analysis for here just recently, and leaving it in the IRA as they go through their retirement years, they weren't just going up one tax bracket. They were going up two, possibly three, plus they were also going to have IRMA charges on top of it. It was going to be a disaster, actually, to leave it as IRA. And yeah, there's a cost up front to make that change over to Roth. But in the long run, it was so much more beneficial. It really, it kind of blew my mind for the numbers for them.
Yeah,
it really is. Paying attention to the taxes is huge.
Yep.
Yeah, I'm glad you brought that up, Josh. That's I never think about that, but that is an area where we let our behaviors, or maybe in this case, it may be a lack of just thinking of it. Right. But people do make bad decisions because they're not taking into consideration that not all of their dollars are going to be taxed the same.
Right. And I think it's not even just behaviors, Tony, but I think we've been trained in this country that what you do is you put your funds away into a pre-tax 401k, you put them into those IRAs, and you save taxes this year because you get a deduction. And once you reach retirement, you're going to be in a lower tax bracket at that time. And that is not always the case.
Right. Yeah, that's a big myth, isn't it? For a lot of people, it's a myth. Yeah.
Mm-hmm.
Yeah, depending on how much you saved, you may end up being in a higher tax bracket than you were while you were working. And if the brackets change, that could throw you off even more. And so paying attention to it while you're younger, while you have the opportunity to actually do something about it is very smart.
Yeah, you guys and Ed Slott are always talking about how so many people have been diligent savers, but they've been saving in these tax-deferred accounts. Right. So when they get into retirement, everything they have, a lot of people who aren't working with somebody like you guys to make sure they've got different streams of income, different buckets. They've got every single dollar for retirement in a 401k or IRA or some type of tax-deferred retirement account, and then they need to, I'm retired, and the first few years I need a little more. I need 6%, 10% out of there this year. And you have to pay taxes on all that money. That's all taxable. So that's a huge issue, isn't it?
It is a big issue, and it's one that we need to pay attention to. And as advisors, this is something that we're always going over with our clients.
Yeah.
It's something we visit with them on all the time.
Yeah. I think that's huge. So I think taxes, we've talked about how fear, trying to hold on to too much cash, trying to get into the market or out of the market at the wrong times based on emotion. And we all get emotional about money. We're all guilty. We're not trying to come down hard on people here on this show. Right. Every one of us has had made emotional decisions with finances at some point in our lives.
Yeah, it's a human error. And, it's one that, I've mentioned it on this show before. This one, when I look at my finances, I make an emotional decision about mine. And, I remember one time Josh and I were talking about something. He goes, and I was describing a particular situation. He goes, Jim, that would work out really well for you to do it that way. I'm like, hey, wait, it really would. If I could have the ability to look objectively at my own stuff, right?
Yeah, you're too close to your own. Yeah, I've talked to financial advisors all over the country, and it's funny how some of them, they've helped hundreds, if not thousands, of people retire early and manage their money. And then they're like, oh, I'm no good with the checkbook at home. My wife handles all our finances. And I can't retire until I'm 70. It's like, you just helped 100 people in the last year retire in their 50s. What are you talking about? Right. There's an old phrase that you guys are too young to know, but they used to say the cobbler's kids have no shoes. Right. And a cobbler was a shoemaker, right? Right. So, and it's just, you're too close to it. But you guys aren't like that. You've got the youth and the knowledge and the understanding, and that's the big advantage there, because you guys are really familiar with the new world of finance. Things have changed since even my mom and dad were saving for retirement. Right. It's a completely different ball game right now. So Luna had to make one more appearance, and we are out of time. She's saying, hey guys, I'm awake now. Let's wrap up the show. So how can our listeners get a hold of you? I mean, the key here throughout the show is you can avoid all these behavioral mistakes if you're working with a trusted financial professional who is removed from it, but can see the big picture that you can't.
Yep, that's right, Tony. Well, listeners, just give us a call. Our number is 417-641-3497, and visit our website at LaTourAsset.com.
Awesome. Again, that number, 417-641-3497. And that does it for today's episode of LaTour Retirement Talk with our hosts, Josh LaTour and Jim Margraf.